So, I mean, this is your first deal ever, right? So, can you kind of tell your experience? Was it like overwhelming, scary, or how did you feel?
It was, yeah, all of those things. So, I mean, it was not scary and like, oh, we're gonna be in trouble. Except, I mean, the scary parts are, that selling is kind of scary sometimes. So you're selling, an investment. Um, so that part's there. But really, it was, once we have to commit our due diligence money. Not all the money is raised normally at that time.
Hmm.
So, that's always the scariest moment is, do we release our due diligence money or not? Um, and because if I don't finish raising my investment, you know, either we're on the hook for it or something bad's going to happen.
Hey guys, welcome to the Realized Gains podcast. I'm Stephen Tran. We're on episode 78. I'm an Oregon and Washington real estate agent, and I'm an investor in multifamily and short term rentals.
Hey everyone, I'm your co-host Jordan Lee, mortgage lender based here in Portland, Oregon. I'm licensed in about 9 states, and I invest in single family. And actually, we have a 2 unit together, and now I'm getting into affordable housing development as well.
Yeah, so we got some fun projects going on. But hey, Jordan, who did we interview today?
Super interesting interview actually. It was an attorney named Tilden Moschetti, and he used to be a litigator, and now he focuses on syndication. So he's a sponsor, which means he kind of does the syndication, but he also does the legal work behind it.
Yeah, no, it's super interesting to see the back end, how he vets out a deal, the clientele that he takes on, and then just kind of running through the different risks that his investors and sponsors may get into. So
Yeah, so if you're interested in investing in a syndication, this would be a good podcast for you. But even more so, if you're interested in becoming a sponsor and syndicating a deal, I think this would be a good episode for you to check out.
yeah, check it out. Hey guys, welcome to the Realized Gains podcast. I'm Stephen Tran.
And I'm your co-host Jordan Lee, and we're super excited to have Tilden Moschetti here on the podcast today. Tilden, do you mind just for our listeners giving us your background and kind of like where you grew up and how you got where your kind of your story, I guess. Yeah.
Yeah. So, I started in, I guess law school wasn't the first thing I had done. I went and got a master's degree before. My whole thought all along was kind of, how do I become a developer and how do I get involved in real estate, and
You wanted to
uh,
do this even like when you were in high school or
even not in high school, but in probably around right after I got out of college. Uh, LoopNet had just came out, and so I had got on it and was like looking at it and it's like, wow, Or actually, there are people buying stuff off eBay, like land and
oh,
homes off eBay,
interesting.
and
Off of eBay.
yeah, and so I was like, wow, that seems like a pretty cool idea. Um, I got an idea to start doing assisted living facilities using manufactured housing.
Mm-hmm.
My grandmother had actually ran a assisted living facility, so that's kind of probably what gave me that
Okay, so you grew up with
general.
that a little bit, yeah.
Yeah. And so that was sort of my idea through business school, and then I was like, well, I still don't feel confident about raising money, so I'm going to go to law school. So I went to law school. I
Mm.
got a little sidetracked. I went and I did all the things that are supposed to happen, where you study mostly property and contracts and things like that.
Mm-hmm.
But then I took a trial skills course and really enjoyed it, and so out of law school, I went and I was a litigator. I started at the DA's office and then quickly moved to my own firm. But it was still around real estate, but mostly about valuations and partnership disputes and things like that.
Okay. And were you like
Um,
investing in real estate at this time too, or you mostly
no,
focused
not
on
at this
your
point.
legal practice?
And yeah, so everything sort of was back burner. Litigation's very all-encompassing of your world when you're in it, and so I really didn't know what was going on. I was really unhappy though, because suing people isn't very fun.
A lot of
So
fighting every day, right?
exactly, no one's happy, and it was kind of dreadful. So I kind of turned it down a little bit and did started doing a little bit of brokerage. I earned a CCIM while I was still litigating.
Hmm.
And then one day a partner showed on the brokerage side showed me a deal. And he said, hey, look at this great deal. And I'm like, yeah, it's super. And he said, we should syndicate it. And I had heard the word before, didn't really know what it was, but was like, okay, that sounds good. Let's do it. And that was it. We did the deal. It took us forever to close just because I didn't know what I was doing, and I was trying to figure it all out. Um, and we were kind of piecing together investors, but eventually it all kind of came together. That deal worked. We ended up doing another and then another, and
Wait,
by
wait,
that
wait.
point,
So is this, hold on. Is this your first investment and you syndicated it? Your first product?
yeah, yeah,
Well, can we back up just a little bit more?
yeah.
Get your CCIM, you have to be in doing commercial real estate for a certain amount, basically. Can you kind of get into
Mhm.
that background of getting started in commercial real estate in general, coming from being a lawyer?
Yeah, I mean, most of it was I saw because I was mostly in the valuation world. I knew a lot about sales and values, and I saw all these brokers making a lot of money, and it seemed like not a lot of work. So so I did some of that on the side. And that I was lucky. I fell in with a team that had a lot of production, and we did a lot of deals together. And I was really good at the finance part.
Hmm.
Obviously, I was good at the contract part, but most of it was for me was I really liked the finance and kind of figuring out pro formas and and that angle of it. And so that just turned into enough of a sales volume in order to qualify. And then the tests were not hard at all for me, but because I was doing so much finance anyway. Um, uh, and then and then that's when this deal had come up. So worked out really well.
And so can you explain for our listeners syndication in like a really kind of straightforward
Yeah.
way that anyone could understand?
Yeah. So, and a lot of people don't know. So listeners shouldn't feel bad if they
No,
don't know
totally. Yep.
because I mean, I think everybody knows what it is, but I can't. I mean, pretty much everyone who I tell them I'm a syndication attorney, they have no idea what I'm talking about. So it is any time that you raise money from investors, it's considered a security. And whenever you're raising money for a security, it either needs to be registered with the SEC. And by registered, we really mean like an IPO. We
Mhm.
mean like 50 lawyers and, millions of dollars and legal fees. It's a ginormous problem. Or it falls under an exemption. The biggest exemption of those is Regulation D, and that's the world that I live in. So what we basically do is the sponsor is identifies a property that they want to syndicate, and they divide it up into membership units. So we may have a $1 million that they're raising. They divide it up into 1,000 units. So now they've got those units that they're now selling to investors. They have 1,000 units to sell. And so what my job is to make that process legal for them. Um, so that's pretty much what syndication is.
And then, so I've been presented with syndication deals, and they have like this thing called like a friends and family deal, or there's like the accredited investors. Can you kind
Sure.
of delineate that?
Yeah, so there's two different kinds of rules under Regulation D. So just there's Rule 506B and Rule 506C. And figuring out which one of those rules depends on a couple things. One of them depends on what kind of investors that you're getting. So we have this idea of what an accredited investor is and what a non-accredited investor is. Broadly speaking, like without getting into the definition yet, the accredited investors have enough money that the government is not as concerned about protecting them.
They
Whereas a
know it's a
non-accredited,
business transaction. If they lose all their money on it,
yeah,
they're not going to ruin their life and have to
they're
lose their house.
they're thought of as more sophisticated, so can weather the storm of losing it all more.
They understand the risk
Um,
they're getting into.
so, I mean, we define it as anybody with a net wealth of over $1 million, not counting the equity in a family home, or making over $200,000 a year for the past 3 years. More if you're counting income from a spouse. That puts you in the accredited category. Otherwise, they're in the non-accredited category. So under Rule 506B, these rules I talked about, you can always have accredited investors. But under 506B, you can have non-accredited investors. You can have up to 35 in any 90-day period. The reason people wouldn't choose that is because they can't advertise. So they have to have a relationship with the person, that basically a way that they could learn about the deal without having seen an advertisement.
So you and
Whereas
your
under
cousins or colleagues or something, you could buy an apartment together with a syndication
totally,
strategy, friends and family.
yeah. Yeah, and that's why we tend to call it a friends and family deal, because really, though, we're talking about people who are going to be friends and family or business contacts.
Got it.
Because I don't have a way to advertise to the general public, it has to be someone I already know. If it's under 506C, I can only take accredited investors, but there I get to advertise. I can put a billboard on Main Street and not have any problem.
Right.
Okay. And so with your first syndication deal that you were mentioning, which direction did you happen to go?
That one we did as a 506B. Fortunately, my network was okay. The network of I knew a lot of real estate investors because of the brokerage world, and then also my partner in the deal knew a number of people too. So we weren't too concerned about having to bring external people in. Um, the next deal, though, was a 506C because we advertised that. And there, was doing everything from cold calling to direct mail to find investors.
Let's walk through the first one. So help us
Sure.
understand like what kind of property it was, about how many
Sure.
investors, and just like what gave you the kind of confidence and mindset to be able to be like, okay, I'm going to syndicate this, because I know a few of us in our sphere that are sort of getting to that point where they're thinking about doing some syndication deals, or have thought about buying into them and kind of on the fence about it and wondering what it takes to kind of get there.
Yeah. So it was a dialysis clinic in Alabama. It was being developed when we found it. So one of another broker actually found the deal by cold calling, and they said that they had this deal they were finishing up. They really were just looking to move on to their next deal.
Hmm.
So
They're
they were trying to become a preferred builder for this clinic. And so they wanted volumes. They didn't really care to own it,
hmm,
and were willing to let it go at a good price. And
interesting.
so for
So it
us,
was like
that worked
80 or
great.
90% completed or something, and then you guys came in and finished it, and then
It was already going to be finished. They were going to finish the build, but I was going to buy it, or I did buy it right after they got their certificate of occupancy.
okay,
Um, but they were just looking to go at the next deal, so they didn't want to list it. They didn't want
right.
anything other than
Hmm.
give me cash so I can go build another.
Um,
Um,
yeah, I was going to ask, I mean, with your past experience with your family with the assisted living facilities, is that why you were like, this dialysis clinic is going to be a gold mine or?
No, so I had done a couple of dialysis clinics before, and so I knew about the industry pretty well. I understood the financials. The financial model on this worked really pretty well for the investors who I knew were going to be coming in. It had regular, consistent, it was going to make good money, like just nice paychecks, every quarter, and then a little pop at the end. It wasn't like a deal where, wow, we have a 300% IRR because this crazy sale price at the end. It wasn't. It made a 15.2%, I think, IRR.
Hmm.
I had promised a 15% IRR, so it worked fine.
And help us for our listeners. Can you explain IRR and this
Sure.
metric that investors are looking for?
Yeah, I mean the IRR is basically the internal rate of return. It's the discounted cash flow of all the cash that is in the deal. You can think of it as a return on investment, though it's a little bit different than that because it takes into account different cash flows. And so it works out to be the generalized, return over the hold period. This one was at about it was just right under 5 years, so 4 years and something. Um, and that on an annualized basis.
Right. So
Um,
you get 15% a year every year for 5 years.
yeah, so I mean,
Essentially.
it worked out. They were getting probably less than that in the first, while during the hold period, and then there was a little bit more money at the back end.
Oh,
So
okay. So it's like averaged over that period of time.
yeah.
Got it. Got it. Okay.
Uh,
Yeah, and I guess help us understand when you're looking at the higher level of these financials, like, because, when we're evaluating apartments or whatever, we're looking at, okay, we already know what the rents are because there's been tenants in there. We've got this history, and maybe we're looking at, we're going to renovate this, and here's what the market rents will be if we up it a little bit.
mhm.
But in a new building like this, where there's no history of it, how do you kind of show those numbers and give your investors confidence, I guess, in that? Were there
Yeah, I
contracts
mean
already
that
set
one was
up
easy
or?
because there was already a lease to the dialysis
Oh,
company,
okay. So
so
it's like a
so I
one.
already knew what it was going to
Oh,
be.
okay. So
Yeah.
you've already have your tenant set up and it's pretty
Okay, so
straightforward.
you don't have to really be focused on the financials of the actual dialysis clinic because they're just paying you to have the space.
Yeah, they weren't going to let it go dark, and so that would have been crazy for them. They
Okay.
they wouldn't have been able to for a lot of reasons. It was an important place for them to be, and so yeah, they were nice and stable. It was for us. It was just a super low risk.
Mhm.
It was going to make money. It wasn't going to make a crazy amount of money, but that was kind of good for us too because it was very believable
Right.
what we were saying the returns were going to be. It's going to, they
I mean,
weren't
one tenant,
nothing insane.
Yeah.
one tenant to worry about, right?
Yeah.
Yeah.
And then what
So
what are your setup? So when you're going in, are you saying, okay, we're gonna sell it at this point, or we're gonna refinance at the end, or how does that
yeah,
portion?
the plan there was there were going to be rent escalations every 5 years, and so we sold. That's why we sold right before 5 years. We baked the pro forma at the rent escalation price, and then so the NOI jumped up as a result, and so when capitalized, it had a better value.
Got it. Got it.
So, I mean, this is your first deal ever, right? So, can you kind of tell your experience? Was it like overwhelming, scary, or how did you feel?
Um, it was yeah, all of those things. So I mean, it was not scary and like, oh, we're gonna be in trouble. Except, I mean, the scary parts are, that selling is kind of scary sometimes. So you're selling, an investment. Um, so that part's there. But really, it was, once we have to commit our due diligence money, not all the money is raised normally at that time.
Hmm.
So, that's always the scariest moment is do we release our due diligence money or not? Um, because if I don't finish raising my investment, you know, either we're on the hook for it or something bad's going to happen.
Yeah, and
So
so for our listeners, the due diligence money, is that like the amount that you're gonna owe that you're putting in escrow for the seller, or is that for
yeah, so
okay.
yeah, that 3% is
3%
most
of
common
the
of
purchase.
the purchase price. Yeah.
Okay, which would be pretty significant. So, and you said you were feeling very confident about getting people in this friends and family in terms of your network, right?
We were kind of confident. I mean, it took us a long time. A lot of it was kind of feeling things out down the road. And, part of that for me was a major learning experience about how to talk to investors and how to work with investors, and get them what they want. And kind of understanding how they look at a deal, which is like probably the most important skill that sponsors learn along the way in the same kind of manner. I try to help my clients as best I can, kind of fit their perspective into it, so that they can see it. But it's kind of a journey that gets taken on your own.
And did you set this purchase up with bank financing as well, or did you syndicate the entire?
There was a lender. Yeah, it ended up being. I'm pretty sure I ended up with a life insurance company, who's such a stable, because the tenant was so stable.
They
It
had a
was
big
very
track
easy.
record.
It was very easy to kind of show that it was super low risk for the lender. So life insurance was what came with the best deal.
Interesting. Well, so time frame wise, you hear about this development, you talk with the developer, you guys come up with the price or whatever. How long does it take for you to get the paperwork done, to get to syndication, to get the loan set up? Like how long was that total transaction?
Yeah, right now, like for me and my clients today, it takes 2 weeks to get the paperwork done.
Really?
For
So
this
you've
for
got it
this
super
deal,
streamlined
it,
down.
for
Okay.
this deal, it took it took, I don't know, 5 months, 4 months. It took a long time because
Mm.
I didn't know how to do it. And so most of it was kind of figuring it out along the way. And I'd see what somebody else had done, and then I'd research it, and then I'd have to like see if it made sense. And
Okay.
so it was kind of a horrible process, but
Well, yeah, I
in the
mean,
end
because
it
you
worked
didn't
out.
have someone help holding your hand through it. You were the one that was like
Right.
doing the legal part, right?
Yeah. So it was a lot of blinders. It taught me a lot. So I mean, there was obviously a lot of good in it. But yeah, it was challenging to not have somebody on that side of it.
But now, if a deal came across your desk, you could theoretically put the paperwork together for syndication in a couple of weeks, assuming that you.
Yeah, I mean, I help about 100 people a year, and my turnaround time's 2 weeks. So
Oh
Well,
well.
after that, what is the time frame that you give to go get the investors? Like, how long does that period usually take?
it's extremely variable, right? So if you have a great number, if you have a huge network, it may not take very long at all. Or, I have people come to me who already have all their investors lined up, or I have people who haven't even begun to look for people. So, yeah, in general, it takes, and with a huge grain of salt, because it depends on the deal and everything.
Sure.
But I mean, it takes 2, 3 months most of the time to have a reasonable raise, for something $2 million raise or $3 million raise, something like that.
And once you did this first project, were you? It seems like were you still brokering for a while, or were you like, this is the thing that I'm gonna do, and I'm gonna just keep moving
No,
forward?
I after probably about by the end of my third deal is when I said, okay, I'm not going to litigate anymore, and I'm not going to. So I shifted entirely to this model. I
Uh-huh.
think I probably did like one or two brokerage deals still, just because I had them.
Yeah.
But it stopped being on my, I haven't brokered a deal in, I don't know, 9 years now. So
Almost a immediate transition, huh?
Yeah, it was very fast um, to this because I had already learned the skill and it was so much more enjoyable and I knew people would pay for it. So
Well, outside of having the skill, I mean, how much of your personal investments were going into these syndication deals? Did you have to have like a nest egg to kind of get started, or were you just
no, that's kind of the beauty. I mean, you always every time no matter, my goal is always zero of my money into it.
Hmm.
And I would encourage all sponsors to have that as a goal. It may not be practical or reasonable, but it's a good goal to set. And I think most of them do get most of my clients don't put any of their own money. Um, uh, if they do, it's most of the time. I mean, I've got people who already own the property, and so they will leave it in or things like that. But I think your goal should always be none of your own money, and then you use your own money for other deals, or you always need your own cash for for getting that seed money in to pay for the lawyers and to pay for the down payments and things like that. Most of the time, I'll get reimbursed for that.
Right. Okay, so you've done a couple of deals. Is there a pattern on these types of deals? Are you doing the same types or just whatever comes across the desk or you're working with your same
Not with me.
or
Yeah. So most people, yeah, for most of my clients, they are very set in what they do.
Mhm.
Mine is completely not. I care more about uh, I care really about interesting deals at this point. If it's got to have some sort of reason for me. Just so like the dialysis clinic was cool. I did a cool uh, office building, medical office building. I've done apartments, I've done hotel, I've done retail centers, I've done industrial, but all of them have something kind of, to me, interesting.
Hmm.
Like the medical office building had a cell tower that I could sell off midstream, and
Oh, fun.
so things like that were just kind of interesting, and so I thought, okay, well, we'll do that.
I mean, do you have a like a tier of basically what is like the lowest risk versus highest risk in terms of the projects you get into?
Um, my in general, the investors that I tend to work with are either or I don't really have a huge number of just pure cash flow investors. So people looking for the 10 to 15% IRRs, or I just generally don't have. Mine generally want 15 is okay, up to 20. Most of mine aren't super risky, so we're not really doing the 25% IRRs.
I've heard that can
Uh,
be a red flag when you see those really high
sure.
R's, like because it's
Yeah, I mean,
really
you
exciting, but
kind of see
then
these ads that are just ridiculous, and and you know that they're not going to get them. So that's a good thing for your. I mean, it really is a if a deal's too good to be true, it probably isn't, or you better really just check it out and make sure. If they're promising, double your money every year, I would really spend a lot of time figuring out how exactly they're going to do that, if that's believable or not.
Yeah.
got it.
I was gonna say my assumption is that the more tenants you have, like apartment buildings, the more risky in a sense, because can you really promise that you're gonna have 100% not vacancy, but
It's
non-vacancy?
the other way though, actually. So
Mhm.
the more tenants you have, the
That's
safer it is,
yeah.
because you've diversified it. So losing one tenant in a 100 unit building is nothing. I mean,
Yeah,
you
yeah.
don't even notice. But losing one tenant in a two-person building is a really big deal.
I'm assuming that you're, vetting those people out, like you mentioned the dialysis clinic, like they're definitely not gonna be leaving in this.
Yeah.
So that's why I thought like,
I
oh,
mean, you always have a mix. Tenants are always mixed. You've always got your great tenants, but your great tenants don't pay as much as your riskier tenants. So, um, I don't know. It always kind of balances out pretty nicely.
So I'm always thinking about syndication in two ways. Like one as being the one that's doing the syndication and one that's, thinking about just buying into a syndication.
Right.
So for our listeners that are like, might have somewhere between, let's say like 50,000 to $100,000 that they're like, okay, I want to invest in something. I want it to be, real estate syndication. I've got most of my retirements sitting in the stock market and whatever index funds, and I'm thinking about doing this other thing, but I don't know anybody in syndication, right? So I like don't
Mhm.
know how to vet them. I also have no idea because when these packets come across my desk, I'm always like, I don't know what anything.
Yeah.
What's like some just general advice that you would give to somebody that's looking at a syndication or, wants to learn how to evaluate buying into one? Because it seems like, there's like new construction, right? And then there's rehabs. I don't know. Maybe you could shed some light on what you think are ones that are worth looking into.
Yeah. I think the first thing is, whenever you're going to give up 50,000 or $100,000 of cash, you got to trust them, right? So, um, and they need to earn the investor's trust always. So, and certain investors shouldn't be shy about that fact. So I'll occasionally hear about sponsors who won't get on the phone or anything
Mm.
like that,
Mm.
no way. There's no
Right.
way I would give my money to anybody who won't talk to me on the
They won't
phone.
answer an email or a phone call, like immediate red
Yeah.
flag, never invest.
Yeah,
Okay.
forget it. I mean, I've got to talk to the big guy, the one who's in charge of the deal at least once, right? I mean, I there's a lot of people will use screeners and things like that, and that's fine. But still, it's a lot of money to the investor most of the time. And so they need to earn it. I don't know a single sponsor, and I know some really, really ginormous sponsors that will always get on the phone with their even their lowest paying subscriber.
Sorry,
Uh,
subscriber wise, maybe 50,000 was too much. Is there some lower levels that people can enter for?
Maybe 25,000 on a smaller size deal. It's rare to have a deal that's worth doing on those.
Okay.
In
Okay.
my experience, if something is coming through regulation crowdfunding, in real estate in general, and this is, the lawyer in general, so I'm not
Yep.
making every deal. It's in general, the fees that are being charged by the portal itself are too high, and it will crush the returns of the investor. So I don't really consider those like a really good opportunity most of the time.
Okay.
I don't think I've ever seen a real estate deal that made sense to me. It probably exists, but I haven't seen
Okay.
it.
So typically you're thinking what's a good baseline that people should be looking at?
I mean, it's a risk reward. So if I knew if this was like super safe, secure, I'd be willing to take something at maybe 10 to 12%. But I mean, it's a grade A plus tenant. It's in
Mhm.
a fantastic area that will never go away. Then, if it was, a prime property in downtown New York, at 10% or 12% is probably pretty good. So,
Got it.
if it's a development opportunity, if it's ground up development in some up and coming area, like well outside of Austin or something like that, I'd probably need to see above a 20%,
Okay.
something like that. So somewhere a normal deal probably is going to be between 10% on the very, very low to as high as 25% on the very high end. Anything more than that, I'd really need to understand why. And as soon as I started not feeling trustworthy, I probably would just walk away go to the next one. There's other deals.
If they're
Yeah.
gonna be promising 25 plus, like I mean, that would be the easiest thing.
Then I need to know why, because I mean, I could put a deal together now that's offering 25 and fill it with, if the risk level was normal. Um, and I could keep the rest of the money myself. So why would a sponsor be offering 50% IRR. I really need to understand it. There could be a good reason, and sometimes there is. Some of my clients have good reasons, but not. It sure better be clear.
Okay, that makes sense.
And what about like just in general for the mindset of someone, a subscriber thinking about joining a syndication? Like why that over just putting your money in index funds? Why is there any tax advantages? Is there
Yeah, there's all that.
yeah,
I
help
mean,
us.
I mean, in my opinion, the world of syndication and alternative investments like this is great, right? I mean, if I invest money today in Apple stock, I'm not going to be able to call Tim Cook on the phone ever and ask him why he did something. It's never going to happen. He will not take my call. Whereas I should always be able to get the sponsor on and at least have a conversation so I can understand what happened to my money. Um, that makes it so much more approachable. About on the stock market, more than 90% of these things are being driven by AI bots that are doing buys and sells and trades and stuff. And the retail investors has no power anymore based on their dollars. Whereas in the alternative space, they have all the power, right? They get to make choices, and if their choices go wrong, there's things that can happen if certainly if they went wrong for reasons that were bad for that the sponsor shouldn't do. So that just gives so much more power, and the upside is so much higher. We also have tax deductibility. Almost all of these are built in LLCs, which allow the depreciation to pass through, so people can offset their income
Yeah,
based
I've
on.
heard about nice depreciation that you can get through these. Does that work for both like W-2 investors as well as real
It
estate
does.
professionals?
It may not have as huge of an impact for people, right? So when the depreciation is passed through, if you do were to accelerate the depreciation, which can be done,
Hmm.
those paper losses can only offset passive losses on the gain. They can't offset income of any sort, even passive income.
Right.
So those kind of things kind of play into account.
When you talk about accelerating, are you talking about like doing a cost seg?
Yeah, yeah. I mean cost segregation.
Yeah.
Oh, and I'm curious about how the syndications market has been in the commercial world over the last 5 to 10 years. I know we've had a lot of struggles in the commercial world. Can you talk about that a little bit?
Sure. I mean, it's still very active. It changes form a lot, or at least from what I see. I mean, I talk to well, even more people a year, and there are a lot of shifts. Like, right, probably about 6 months ago, a year ago, 6 months ago, a huge number of the people were just doing hard money lending and were putting together funds to do hard money loans, and a lot less development work. Right now, there's kind of there's a lot more interest in like putting together like businesses and sort of related things, or real estate with business components, um, like, hey, we want to build out this place for our restaurant or for whatever, is probably more prevalent than it was, certainly than it was a year ago. Um, so these kind of big things change, but there are still people out there that are just finding good deals, finding something that's land. Normally, there's some sort of value add to it to make sure there's enough of a return. Um,
Yeah, I was talking specifically like maybe like during COVID. I'm sure nobody could have
yeah.
projected that that would be a
No.
situation that would happen, in their projections when they were doing their syndication for
Yeah. Do you have
acquisitions.
any horror stories from that time with any of your syndications?
I mean, I was only in one when COVID hit, and I was pretty lucky that, I mean, the tenants all stopped paying, but but I was working with another partner, and the partner said, I want to try a deal where we don't raise any. We're all really kind of concerned um, about what the bank rates would do.
Hmm.
This was before COVID, and so we decided to do it an all cash deal,
Hmm.
which totally saved our bacon. So because every investor stopped paying, I mean every tenant stopped paying,
Uh, but then you didn't have a
and
loan to pay.
but we didn't have a loan, so it was we majorly depleted our reserves because I needed to still pay for trash and all
Right.
these other
Yep.
things. But there was very low, uh, nothing was going to happen. So it was they weren't going to certainly weren't going to foreclose on us, and
Right.
because there was
Right.
no one there.
Yeah.
Um, so there it was more of an investor relations thing of, hey, this is what's going on with our tenants. We don't have a loan problem though. So
Nice. So
that
what did
strategy
how did
worked.
you guys resolve it? I mean, did you just wait it out until were
Yeah.
able to get new tenants basically?
Yeah. And the tenants all came back and they paid their rent. They
Okay.
all caught up and
This
yeah,
was
it worked out.
office space, I'm guessing, or was it?
Yeah. Yeah. It
Yeah.
was a medical office space.
Okay.
Um, so yeah, it worked out okay. So we
That
were we
sounds like a
were
pretty mild horror story to me.
no, it wasn't. Yeah, ours wasn't horror at all. It was very lucky and not at all scary. And that was kind of telling too. Like, okay, you gotta, you over leveraging really can hurt you pretty badly
Did you
if you don't
see
have aren't ready.
Yeah, did you see any other sponsors that kind of are getting stuck in this
Oh yeah.
environment where, um, rates went up, so their loan, because the loans are typically set for like 5 years or something, so they had to redo their mortgage and then their tenant money.
Yeah, more in the retail space.
Okay.
Even in the multifamily space, a lot of people survived pretty well. There were a lot of banks were able to push things off, and rates just got down to nothing. So especially, I mean, there were people who were getting like 1%, their loans at 1% and like crazy stuff. Um, and so they tended to do pretty good. Retail centers were pretty mixed because there was a lot of problems. If there was enough food in it, then places were doing okay. But if it was any kind of shopping or anything,
Yeah.
they were doomed.
Assuming office too, with the whole work from home situation that people started.
Oh yeah, I don't. Fortunately, I wasn't. Yeah, I mean, medical office has to be there, but regular office, I would not have wanted. I haven't owned an office property since. So.
And if you're invested in one of those as a subscriber, is there any recourse for you if
No,
you're just kind of
no. I mean, the whole process really is, and investors need to know. I mean, the reason that I get hired. I mean, I'm hired by sponsors to protect themselves, and and by informing investors, investors are protected because they're informed. But they need to know they can lose their money. There have been big cases that have made the news and stuff where the sponsor, like out of Texas, there was a huge one went down. And they lost like 500 million of investor money. And although the underwriting was terrible from my looking at what the underwriting was, they the sponsor didn't like make an actual error that would be actionable from my point of view.
Hmm.
And the investors just they got went into the wrong deal. They just trusted the wrong deal. It was
So
terrible,
help us
but
understand that. So like, let's say I was like, oh, I want to figure out how to sponsor. I've got this apartment building that we're thinking about building, but I don't know how to syndicate. So can I call you and have you help
yeah.
set it up? Is that kind of what you do?
Yeah, most of what I do. I mean, my practice is a little slightly different in a good way. So I do the normal paperwork, the private placement memorandum, the operating agreement, all the legal
Uh-huh.
compliance setup work. But I also have coached before and like things like that in the past, and so I really feel like if I can help my clients be successful, that's what I do. So really it's, if they need help on marketing or they need help on, how would I pitch this deal? Or, hey, can you look at this underwriting? I have some clients who show me deals before they buy them and just say, hey, can you look at it and see if I think this is good, but I just want another set of eyes. I'm always happy to do that because ultimately that just means they hire me more. So,
Well, with somebody, if someone wanted to step into your type of role, I know you have a vast experience in, like you mentioned, law and working in commercial real estate. What would be the strongest skill set that they can gain? Should they go get their law degree, or what? How can they get started?
no, I mean, not unless they want to be a syndication attorney. I mean, if they want to be a syndicator, I wouldn't become, I mean, law school is great and it's a great skill set, but I think it's probably the a lot of the really successful people I know have a background in brokerage or especially like in working at banks or just knowing how to underwrite a property
Right.
well.
Yeah.
And then and then the sales piece isn't really that bad. I mean, it's probably the scariest. It was the scariest for me, and it's the scariest for a lot of people. But if you can identify what makes your property special and the underwriting looks good, you'll find investors.
Yeah, I mean, I'm sure you have a pitch deck, and if, like I said, if the numbers look good
Yeah,
and things look fairly stable and there's not too much risk, then why wouldn't somebody jump in, right? I mean, I'm sure somebody
yeah.
can make someone feel unconfident feel unconfident if the speaker isn't confident.
Yeah, well, sure. Yeah, but a lot of it is confidence and, not being afraid to say, I don't know, let me find out for you. You look a lot more incompetent if you make something up and it's totally wrong. And if you say, I don't know, let me find out.
That's what I do as an agent. Confidently say, I don't know, but I'll find out. you know.
Yeah, exactly. It's much better.
Well, I would love to know, like I said, like what would be the best way for someone just to get started, like just as a syndicate.
Really, you take the plunge. So, I mean, the way most people get started is they run across a good deal or they think it's something they want to do. Just start talking to the network and say, hey, if I did something like this, does that sound like something that you would invest into? Most of the time, people are pretty interested. And as that sort of starts coming together, the deal's either there or it's not. And a deal comes up at some point, and at some point you decide, yeah, that's good enough that I'm willing to take a chance. I mean,
And
if you do it right and you put it together, there's not a huge amount of damage that gets done. I mean, you may have spent some money on legal fees and due diligence and things like that, but if your deposit is returnable, is refundable, you may have some slight embarrassment with your investors, but really at the end of the day, you save them from a bad deal. So it's not really that embarrassing if you have to pull out of something.
can I ask what would be a general cost for the legal fees and everything outside of the down payment, just to kind of get the ball rolling if you found a project and you wanted to get running with it?
Yeah, I mean most lawyers like myself are somewhere in the $10,000 to $20,000 range. And then if that for the more boutique firms, if the more the big law firms I would steer away from. They tend to charge a whole lot of money. They do a fine job, but they have a lot of mouths to feed, so those can be like 40,000. So uh, you know, and in my very biased opinion, you get better service from a boutique anyway.
Got it. Got it. And so you will help with all the like legal documents and the way that your fee structure is it, do you get paid out of closing or is it you get paid up front or
No, I almost all of us are flat fee.
okay.
Some people charge more for certain things. I'm just truly flat fee. And then almost all of us get paid up front. So
Okay. Okay, makes
I
sense.
mean, outside of just getting paid flat fee. Are you getting into syndication deals yourself with your own money?
Yeah, I do, but not with clients. I think that's a conflict of interest.
Oh,
So
makes sense. Yeah. Yeah, makes sense.
Great. So basically, well, I would want to ask, like, if somebody wanted to get a hold of you to, to get advice on syndication, what is the best way to do that?
yeah, so my website's great, moschettilaw.com. They can always call. And then I've got a ton of videos on YouTube too that kind of talk through. I think I have like 150 videos or something. So we go through a lot. So really, if you have a question, there's probably a video I've done on it.
Oh, so we can
Um,
probably go to your YouTube university and learn how to do a syndication as well, huh?
yeah, exactly. I try and my philosophy is I kind of give away the store of as much as possible because I know I have good service, so people keep hiring me.
How do we find you on YouTube? What would be the best way to do so?
So it's just youtube.com/ @ Moschetti Law. We'll get you there.
Yeah, we do want to highlight that you are an Oregon Duck, so I don't think
And I am an Oregon Duck. So uh,
And if you had to recommend for the first time syndicator, like the easiest type of deal, like that you've seen, or the most successful ones that to go through, what would you recommend?
in general, I think storage is a little bit simpler than even more simple than apartment building. There's a lot of people doing apartment buildings, and finding a good deal is challenging. Um, like if I had somebody brand new, I'd probably say, hey, take a look like at boat and RV storage because they make a lot of cash with very little development. Um,
I've heard good things
those,
about storage, because no landlord tenant laws really that you have to deal with, easy
yeah,
construction.
no,
But
just
wait, you would recommend construction or buying one and that's
no, no, just yeah, just getting it ready.
yeah.
I know there'd be very little construction on it. Or so that would be a certainly simpler project to look into. That will make good money. So you'll get investors that will be interested because the numbers are going to speak well.
And
So
is there like a price point or like a region that you recommend or
not there. I mean, I would encourage people to raise over 1 million because at that point the it starts being worth it for the syndicator
okay.
to put the deal together. And then I probably would say stay under a raise of probably under 5 million of a raise. Once you get more than that, it raising money does take a lot of work. So start on the smaller side of it rather than the bigger.
Yeah, I was always curious about storage, like how do I know if areas, well, obviously I could do my research and see like is there too much storage in this area or is this actually gonna, do well? So that was always my concern with getting into storage because there's huge.
Yeah, I mean it's just density. It's just number of storage space places in a given area and the density of the population. So.
Okay, can you go through that calculation real quick? I mean, you don't have to get too complicated, but how will you go through that calculation? Is like with a certain mileage, or how do you figure out your
Oh, I
metric?
mean, I'd probably no, there's nothing. It's more of a gut feel than anything else. I mean, I would just look at the population in a given area. Probably, nobody wants to drive too far to a storage space, so probably a 20-minute drive time is probably the max, I would think.
Hmm.
And so within that 20-minute drive time of where my site is, how many storage spaces are there, and are they, if there's five, but there's 5 million apartment buildings, well, I'm not going to have any problems. But if there's five and I've got this one little 10-unit apartment building, then it's probably going to be a problem.
Yeah, I don't know where the metrics are, where the population makes sense for a certain amount of storage units, if that makes sense. Like if I have
Well,
like,
you can also call around to the storage unit places and say, hey, do you have do you have vacant units? Act as a prospective renter.
yeah,
And if they say, yeah, we have a lot, then then you got to know, well, they've got a lot. So
I'm thinking of getting like 10 or 15 units. Do you have a bunch available?
yeah, I mean, why not? You could certainly say that. Hey, I've got a few businesses, or my family wants to do this, but want to keep our units separate. Can we something? I don't know. Just
That
call.
is a good way to vet it. I
I
haven't thought
like
about
it.
it that way.
Yeah.
Yeah.
Cool.
Great. Is there any last tips or recommendations that you have for anyone thinking about syndication or?
It's really I mean, once people start doing it, generally they keep doing it. So it, it is enjoyable. It's nice. You're making people money, so everybody likes you. So it's a pretty good world to be in.
No, I like that. No, and I think you've given a lot of people the confidence to kind of get to make that first step into that world. So
Yeah, appreciate it. Thank you so much for your time.
Yeah, absolutely. It was nice to meet you all.
Yeah,
thanks.
pleasure.